How to control your emotions when investing. Hey everyone, welcome back to Finance Clarity. Let me ask you something honest. Have you ever bought a stock or investment because everyone else was talking about it, only to watch it crash shortly after? Or have you ever sold an investment in a panic during a market drop, only to regret it later when prices recovered? If you have, you're not alone. In fact, this happens to the majority of investors, even experienced ones. Here's a hard truth that most people don't want to admit. Your biggest enemy in investing is not the market, the economy, or even bad investments. It's your own emotions. Fear, greed, FOMO, fear of missing out, overconfidence, and regret can cause even smart people to make terrible investment decisions. Studies have shown that the average investor significantly underperforms the market, not because of bad stock picks, but because of emotional decision-making. The good news is that controlling your emotions when investing is a skill you can learn. It's not about eliminating emotions completely, but about recognizing them and making better decisions despite how you feel. In this video, I'm going to show you how to control your emotions when investing in a practical, realistic way. I'll explain why we behave the way we do, and give you specific techniques to stay disciplined, even when the market gets crazy. If you want to become a calmer, more rational, and more successful investor, stick around. This might be one of the most important skills you ever develop. Let's get into it. Why emotions are so dangerous in investing. Investing is one of the few activities where doing the opposite of what feels natural is often the right thing to do. When prices are rising quickly, our natural instinct is to buy more because we don't want to miss out. When prices are falling sharply, our natural instinct is to sell because we want to stop the pain. Unfortunately, both of these emotional reactions tend to hurt our long-term results. Buying at market highs and selling at market lows is one of the most common ways investors destroy their own returns. This behavior is so widespread that financial researchers have a name for the gap between what the market returns and what the average investor actually earns, the behavior gap. Emotions cloud our judgment. They make us focus on short-term movements instead of long-term goals. They push us to make decisions based on what feels good in the moment, rather than what's actually good for our future. This is why mastering your emotions is often more important than picking the right investments. Common emotional mistakes investors make. Here are some of the most frequent emotional traps that hurt investors. 1. FOMO, fear of missing out. When a stock, cryptocurrency, or asset class is rising rapidly, many people feel intense pressure to buy in before it's too late. This often leads to buying at very high prices, right before a correction or crash. 2. Panic selling. When the market drops sharply, fear takes over. Investors sell their investments to stop the bleeding, often at the worst possible time. This locks in losses and causes them to miss the recovery that usually follows. 3. Overconfidence. After a few successful investments or a bull market, some investors start believing they're better at picking stocks than they actually are. This can lead to taking excessive risks, overtrading, or concentrating too much money in a few positions. 4. Loss aversion. People feel the pain of losses much more strongly than the pleasure of equivalent gains. This causes investors to hold on to losing investments too long, hoping to break even, while selling winning investments too early. 5. Recency bias. We tend to give too much weight to recent events. After a long bull market, people assume stocks will keep rising forever. After a crash, they assume the market will never recover. 6. Herd mentality. When everyone around us is buying or selling, it's easy to follow the crowd instead of thinking independently. This is what creates market bubbles and crashes. Why we struggle to control our emotions. There are biological and psychological reasons why investing triggers such strong emotions. Our brains are wired to avoid pain and seek pleasure. Seeing our portfolio drop triggers a fear response similar to physical danger. We are social creatures. When everyone around us is excited or scared, it's natural to feel the same way. We hate uncertainty. Markets are inherently uncertain, which creates anxiety. We're not naturally good at thinking in probabilities and long time horizons. Our brains prefer simple, immediate answers. Understanding that these emotional reactions are normal can actually help you manage them better. The goal isn't to stop feeling emotions, it's to recognize them and make decisions anyway. Practical techniques to control your emotions. When investing, here are some effective strategies you can use. 1. Have a written investment plan. Before you invest, write down your goals, time horizon, risk tolerance, and strategy. When emotions run high, refer back to this plan. It helps you stay grounded instead of reacting impulsively. 2. Automate your investing. Set up automatic investments, dollar cost averaging. This removes the emotional decision of when to buy and helps you stay consistent, regardless of market conditions. 3. Limit how often you check your portfolio. Constantly checking your investments increases emotional reactions. Try checking only once a month or once a quarter. Less information can actually lead to better decisions. 4. Use rules-based investing. Create simple rules for yourself. For example, I will not sell any investments unless I need the money or my investment thesis has fundamentally changed. Rules reduce emotional decision-making. 5. Focus on process, not outcomes. Instead of obsessing over short-term returns, focus on following a good process. If your process is sound, good long-term results usually follow. 6. Talk to someone objective. When you feel emotional about an investment decision, talk to a trusted friend, mentor, or financial advisor. Explaining your thinking out loud can help you see emotional biases more clearly. 7. Practice mindfulness and emotional awareness. Simply noticing when you're feeling fear or greed can help you pause before making a decision. Ask yourself, am I making this decision based on logic or emotion right now? 8. Zoom out. When markets are volatile, remind yourself of the bigger picture. Look at long-term charts instead of daily or weekly movements. This helps put short-term noise into perspective. Building the right investing mindset. Controlling emotions becomes easier when you develop the right mindset. Here are some important mental shifts. Accept that volatility is normal. Markets go up and down. This is not a bug. It's a feature of investing. Think in probabilities, not certainties. No investment is guaranteed. Good investing is about increasing your odds over time. Focus on what you can control. You can't control market returns, but you can control your savings rate, costs, behavior, and time horizon. Detach your self-worth from your portfolio. Your net worth is not the same as your self-worth. This helps reduce emotional reactions to market movements. Play the long game. The investors who do best over decades are usually the ones who stay calm and consistent through all market conditions. Real examples of emotional investing mistakes. Let's look at some common real-world examples. During the 2020 market crash, many investors sold their stocks in panic. Those who held on, or even bought more, saw strong recoveries within months. In 2021, many people bought cryptocurrencies and meme stocks at extremely high prices out of FOMO, only to watch most of those gains disappear. After a long bull market, some investors become overconfident and take on too much risk, only to get hurt badly when the market eventually corrects. These patterns repeat throughout history. The investors who succeed long-term are usually the ones who learn to manage their emotions instead of being controlled by them. Final thoughts. Controlling your emotions when investing is one of the most important skills you can develop. It's not about being emotionless. It's about recognizing your emotions and making rational decisions anyway. The market will always be emotional. Prices will rise and fall, sometimes dramatically. Your job as an investor is to stay as rational as possible through all of it. This doesn't happen overnight. It takes practice, self-awareness, and a commitment to long-term thinking. But the investors who master their emotions consistently outperform those who let fear and greed drive their decisions. If you can learn to stay calm when others are panicking, and stay disciplined when others are getting greedy, you'll already be ahead of most investors. Thanks for watching. If this video helped you understand how to manage your emotions while investing, please like and subscribe for more practical investing and personal finance content. Drop a comment below and let me know which emotion you struggle with the most when investing: fear, greed, or something else. I read every comment. I'll see you in the next video. Take care.